Good morning. David Schill, Catapult Wealth Partners, with the market update for the week of September 12th. Hard to believe that yesterday marked the 21st anniversary of September 11th, and our hearts go out to the families who lost loved ones on that fateful day in September when the World Trade Centers were subject of a terrorist attack. Last week saw the financial markets turn in a positive week in the equity markets, and this was in fact the first positive week that we saw in the last three. The S&P 500 index rallied 3.68%, the Dow Jones Industrial Index rallied 2.72%, the Russell Small Cap Index was up 4.07%, and the Nasdaq tech-laden index was up 4.15%. The international markets, with the MSCI EFA index, was up slightly less than 1%, and the emerging markets index was just slightly negative. On the interest rate front, we saw the yields move significantly higher across the yield curve. The 10-year Treasury bond yield moved up from 3.2% to 3.33%, and on the shorter end of the yield curve, the 2-year Treasury moved up 16 basis points from 3.4% to 3.56%. So what actually caused the markets to move the way that they did last week? We do think that the increase in interest rate yields are tied to the expectation that the Federal Reserve is going to go 75 basis points at the conclusion of the Federal Open Market Committee meeting that will conclude on September 21st. Jay Powell, in an address last week, again reiterated that the Federal Reserve is going to stand firm on its curtailment of inflation until the job in fact is done. And we do think that regardless of any economic data that comes out prior to this meeting, that the Fed will stick to its guns and will raise interest rates by that 0.75% for the third time in a row. And we still expect them to actually continue raising interest rates through the end of the year. So why did the equity markets rally? Well, we believe that the equity markets actually rallied last week because the expectation is that inflation numbers that come out this coming week are in fact going to be a little better than what was previously expected. And looking through all of this, we do see some point earlier next year where the Federal Reserve may actually say that they are going to hold off on further rate hikes and sit tight before they actually start loosening monetary policy later on in 2023 or even early 2024. As we've seen over the past year or so, any time that interest rates, or the perception that interest rates move lower, tends to be pretty good for growth stocks, and hence the Nasdaq index was the one that really rallied last week. Those technology companies tend to love lower interest rates. They really don't like interest rates being hiked. So this week sees the economic data coming out. Tomorrow sees consumer price index numbers, and we actually believe those are going to be better than what we saw the prior month, where the rate moved down to 8.5%. We think that the rate may move down as low as 8.1%. A day later on Wednesday, we will see the producer price index, which is also expected to show an improvement in the inflation numbers. This is at the producer or wholesale level. And then on Friday, we'll see the University of Michigan release its consumer sentiment index for September. And we think that that index will actually move up slightly, giving us an indication that consumers are actually feeling just a little bit better than where they were about a month earlier. All in all, a busy week. Stay tuned, stay invested, and we'll speak to you again next week on Monday. Have a great investing week ahead.